For those joining the room right now, our presenters are here and we'll start in a couple of minutes. Hello and welcome, everybody. Today we have Mike Larson, our editor-in-chief here at The Money Show, and Ryan Detrick, chief market strategist at Carson Group. Gentlemen, the floor is yours. If you need anything, I'll be right here. And for people in the audience, if you have any questions, feel free to type them in the chat.
Wonderful. Thank you, Sam. Ryan, welcome. Glad you could join me.
Glad to be here, Mike, and thank you for inviting me. This will be fun. It's always shocking how quickly 30 minutes goes. And this is kind of neat, like fireside chat, but it's hot outside, so I'm glad we're not by a real fire. There's no need for that. It's nice and cool in my basement, but it's still a nice firside chat. So thanks again for having me.
Yeah, there you go. I mean, I'm in South Florida, so I will definitely second that. I
There
got
you
the
go.
AC cranking as well. So, in any event, yeah, great to have you here, Ryan. I know I followed your work for some time, a lot of things you have on social media and what you do with Carson there. But just for somebody who may be, meeting you or watching this for the first time and not know a little bit about your background, why don't you just start by explaining, what it is you do at Carson, a
Yeah.
little bit about your background before there, and we'll take it from there.
Absolutely. So start in the beginning, right? I guess we'll say. So I'll start with Carson. I'm the chief market strategist with Carson Group. We're I believe up to 47 billion. Okay. I mean, every day is a little different, but up to about $47 billion. I think we're in 42 or 43 states. The reason I say that, because we're about to sign some in states we're not in, have almost 500 financial advisors all around the United States. My team, our investment team, manages about $5.5 billion. So as a market strategist, I do things like this, get to talk the big macro thing. I've got a face for radio, apparently, because they keep inviting me all these places to talk about how we see the world, but we also manage money. So if you see me talking on CNBC or on this, for the next 27 minutes or so,
Yep.
it's how we manage money, right? And again, real quickly, a little more about me. Been in the industry for 26 years. I've obviously leveraged social media a lot. I've got a lot of Twitter followers, been doing media for a long time. I've kind of found a niche, if you will, for looking at history, telling stories, adding a little bit of humor, but also hopefully being more right than not. I do have a CMT behind my name. That's a
Yep.
chartered market technician. I'm not your average strategist that says, wow, did you see those fundamentals? Did you see those valuations? Yes, I look at that, but I'm looking at things like relative strength, seasonality, sentiment, the different things like that. We'll get into it, but it's been a fun career so far, and just look forward. Every day's different. Every
Yeah,
day is
yes,
different. That's what
it
makes it
certainly
fun.
is.
Yeah.
All right, great. Well, I appreciate the background. I'm sure everybody listening, watching, it'll help them kind of understand where you're coming at this market
Mhm.
from. And I wanted to start. I know you were on with JC Parrots and Sanu, I think it
Yeah.
was not long ago, and you characterized this market. You said we're in a healthy global bull market. I mean, that was kind of the takeaway headline from that. Talk a little bit about that. Expand on that. Why do you think this market still looks healthy?
Mhm.
Why do you characterize it as a global bull market as well?
Yeah, a few things there. This bull market, Carson Group was one of the very few places 2 years ago that was optimistic. I mean, everybody says, "Oh, everyone's bullish." No, trust me, we were bullish 2 years ago. People hated it. I don't know why they just did, but we've still been in that camp. But for the last couple of years, Mike, it felt like U.S., India, and maybe Taiwan, like the three areas that did really well, right? And what's happening this year is clearly the baton's being passed around. Most of Europe's up 20%. A lot of emerging markets up double digits. U.S. up ballpark double digits. It is a more of a global bull market. We were very overweight United States equity specifically the last couple of years. Back in March, when we saw some of the fiscal policies and things taking place in Europe, specifically Germany, some of the defense spending. You hate to say this time is different, four most dangerous words, but we talked on our team, it was a little different. So we added some more international exposure, specifically Europe, developed international, and that's obviously done really well. So
Yeah.
again, we'd say more of a global bull market right now because we have participation. I mean, I follow like 39, 38 countries. Every one of them's positive on the year. I'm sure there's some negative performer out there somewhere, but this is more of a global bull market. And to us, from a diversified portfolio point of view, that should be music to a lot of people's ears. You don't have to be just in the Mag 7 to make money like you really had to the last couple of years.
And what do you think is driving that? I mean, to
Yeah.
me, it's sort of ironic. I mean, Trump is all about America first and forget the politics of it. Just from a market standpoint,
Yeah.
it seems like, a lot of things he's done, we've ironically seen foreign markets performing a lot better. So I'm kind of curious about that dynamic. What do you think's fueling that?
Yeah, a couple things are a great point. Like Mexico, as of Friday, at least Mexico's up like 24% for the year. All right, we thought that the tariffs
Yeah.
are gonna be a little harder on Mexico. Not so much. A few things there. First off, global. I mentioned earnings. I think I mentioned earnings. Maybe if I didn't. Anyway, earnings in the United States forward estimates are all-time highs. We've got new cycle highs in profit margins. But then you look around the globe. I mean, we're having stronger earnings across the globe. And one thing about the market that I've learned doing this for 26 years. It's not about good or bad. It's about better or worse. This time at the start of the year, everybody was bullish the U.S. Everybody's looking for 2.5% growth on GDP and blah, blah, blah. And Europe, oh my God, Europe's been terrible for 16 years. Europe's going to be flat GDP. Well, now Europe's growing about 2%. We're growing about 2%, but it's all about those expectations. That's where things have gotten a lot better. Now, specifically on President Trump, great point because, well, what was going to happen under him? Lots of different things. One of them we expected, though, and a lot of people didn't. Start of the year, everybody said dollar's going to go higher, right? The Economist had that picture of the $100 bill flying into outer space with like gold speckled dust around it, saying how great the United States was and the dollar was. Well, the dollar had one of its worst first 6 months ever in history, right? If everybody's thinking alike, somebody isn't thinking. I use that a lot. General Patton. We expected to see potentially a lower dollar because that's what we saw the first time on the Trump 1.0. And the dollar going lower, just keep it real simple, look at history, you tend to get more dispersion around the globe. You seem to see global markets do a little bit better and multinationals do a little better with earnings. I mean, everyone's talking about the dollar being weak, and we get it. Dollars where it was trading like 4 or 5 years ago. It's just in this big old range. Yeah, it's down a lot lately, but we've had bull markets with dollars down, we've had bear markets dollars down, and vice versa. But a gently trending lower dollar to us is still probably the play, to be honest. But it means global markets do a little bit better, and that's how we position our portfolios. And fortunately, knock on wood, that's worked. And we think it'll continue the second half of this year.
Okay, sounds good. You touched on a couple things that got me thinking, and one of them was earnings, of course. I mean, we're almost at the tail end, or pretty much at the tail end of the
Yeah.
Q2 season. And I think I saw from Goldman the other day, we're up about 11% in terms of S&P earnings versus like 4% coming into the season. Thoughts on that? I mean, why are we seeing such a solid performance when I think coming into the season, we're worried about margins, tariffs, trade ramifications, all that kind of stuff.
Well, you're right. I think FactSet had like 81 or 82% of companies have beaten on revenue and on earnings. And once again, this is kind of the game that gets played. You lowball it and you come in. Friend Sam Stovall, and you follow Sam. He's pointed out, going back like 20 years, only like once or twice have earnings come in lower than expected. And it was like COVID, right? So this is the game that's played. But even then, things have come in better. It's a lot of it is. I'm going to sound like a broken record, probably with other people. AI is a huge part of it. You look at like the four big companies, Microsoft and Meta and Google, and I'm forgetting one of them, but the four big ones that are really investing in AI, it was like capex of 150 billion this time 3 years ago. It's going to be 300 billion now, and not slowing down. So again, is AI keeping this bull market going? Maybe it is. When you look at GDP growth, again, U.S. growth is kind of below trend. We came out with our outlook, mid-year outlook, a couple months ago, well, month and a half ago, and said expect potentially lower growth going forward, maybe between 1.5%, 2%, not the 3% we've seen the last couple years. But we're seeing a huge jump, clearly, what I just said, in AI spending. So we're starting to see that there was actually more GDP growth the first half of the year from CapEx spending on AI than there was consumer. Now, historically, the consumer's two-thirds of the economy. I think that'll probably likely will come back. But again, that's another big reason why we think we are where we are.
Okay. Let's talk about AI. I mean,
Yeah.
being that you've been in the business as long as you have, you're old enough to remember the dot-com boom and bust. And, is there any similarity to what you think what's going on in AI? Do you think this is a completely different ball game? I mean, are there concerns out there? Just kind of your thoughts on the AI boom slash whatever you want to call it.
Yeah, so for those who remember their history, I keep saying 26 years ago. If you do your math, that's 1999. I was in college, Xavier University, Cincinnati. My dad gave me, I don't know, like 4 or 5 grand. I didn't know what I was doing at all, but I just watched CNBC and they'd use the word Sycamore Networks, Juniper, Netscape, all these names that don't ring a bell now, and they'd go up and you make money. And I was just leveraged to the what, making money. I made a ton of money in a hurry, and then it all crashed. And I was on margin, and I learned a very valuable lesson. Leverage works both ways. I didn't know what I was doing. And then it clicked. Someone said, a lot of people made money on the way down. And it clicks. Oh my God, you can make money on the way down? And I didn't know what I was doing. So I said, okay, that's what I want to do with the rest of my life. So I've done it since then.
Yeah.
But now, there are some concerns clearly with valuations. Where are the most bubblicious? I hate to use that. I shouldn't use the word bubble, but the most bubbly areas of the market and valuations. Well, it's tech, right? I mean, it's tech and tech adjacent things. That's where the growth is coming from. So we are overweight large caps. We've got a slight overweight technology. If you have a large cap exposure, we've got technology. That's what it is. So we're not blindly and wildly overweight technology here. So we see some of those worries. At the same time, that's where a lot of this growth is coming. And I follow smart people like Dan Ives, and Dan Ives is saying we're still the fourth or fifth inning. And I don't know. I mean, we'll see. I think when you manage your own money, you have to have some tech exposure here, and that's still where the earnings growth is coming from, and that's how we see it. But one more thing on this, I mean,
Sure.
literally, like, people, it was crazy in the late 90s. I mean, if you weren't there, you don't remember, but people were just the hot tubs buying stocks and doing crazy, flying to Vegas, crazy stuff. It's not like that. I will say late 21 had some feelings like that. Government gave everybody money, everybody went in crypto and SPACs, made all this money. And then what happened? That burst. And what happened the next year? Stocks down 20%. Bonds had their worst year since George Washington was the president, right? Late 21 felt like we had to pay the piper because everybody's making too much money. Everybody's having too much fun. There's those TikTok videos of the husband and the wife saying, all I do is I buy a stock, it goes up, then I sell it. Like it was just mind boggling. Like that's, anyway. But the reality is I'm just not seeing that stuff. When I present, I travel all over the country. It's not like people ask me, wow, this is great. This market's up a ton. How much further can it go? It's always the negative. And in late 21, it did feel like it was a little overboard. And boy, we paid for it in 22 in a big way.
Yeah, it's funny, and just to date myself too, I graduated college in '98 and went to work for Bankrate.com, formerly Bankrate Monitor, as my first
There you
job out
go.
of college. So, there was the .com that got it. And so firsthand, I had a few fun experiences as well. Let's leave it at that.
Yeah.
But in any event, yeah, I know I tend to agree with you. I think 21 was probably more in that category with just there's a brand new SPAC every day.
And I'm kind of limited what I can talk about crypto. I'll just say this. In 21, everyone's talking about crypto. Crypto is making new highs. I know it's down the last few days. I'm not seeing a lot of people talk about it. Again, that's from that point of view of what's the biggest risk asset out there. Well, crypto's strong. That's probably good for tech and probably good for, honestly, risk assets. I'm not hearing too much about that. And again, I think that's comforting from a bull market point of view.
Well, you brought up crypto, but I'm going to bring up another alternative asset you've talked about recently, and that's gold. I
Yeah.
mean, you've mentioned, I think you had the B of A fund manager survey you cited the other day. Like, 41% of fund managers don't even have any exposure, which is amazing when you see how big the run's been. What are your
Yeah.
thoughts on that?
Well, I like seeing that again from a contrarian point of view. So we added gold to our shorter term tactical model. So when I say tactical model, think 6 to 9 month holding pattern or holding, at least a holding. But believe me, we've held it longer. In April of 2023, that was after the SVB crisis. The thing's a little squirrely. We saw some reasons to have a diversified portfolio, adding a little bit of gold. Well, clearly, gold's done incredible since then, and thank goodness we did that. We never looked at gold like gold versus stocks. We looked at gold versus bonds, right? 60% stocks, 40% other stuff. One of the big themes we've had this year, Mike, is to diversify your diversifiers, meaning don't just stick in 40% bonds over there. We have some managed futures. We have a little bit of cash. We have some gold, like I said, and yeah, we also have some bonds. But reality is, I mentioned the dollar. Well, the dollar lower historically is better for gold. With all the crazy stuff going on out there, that can be good for gold. We know central banks are gobbling up gold and seemingly not slowing down either. So to me, we have some gold. We actually just added a little bit more gold in our strategic model. So when I say
Okay.
strategic, we're talking 3 to 5 years. We added that maybe 3 weeks ago because I saw gold go up a whole bunch. Everybody else saw the same thing I did. And for 5 months, gold's gone sideways. To me,
Yeah.
you can kind of correct through price or time. Well, gold is very, very, very overbought. It's correcting through time, in my opinion. It's going sideways. I think it's about to have another upward trajectory. I think we're in a major secular bull market for commodities in general as well that can
Yep.
last years. Gold just broke out to new highs in 2024. That was last year. Okay.
Yeah.
So like last year is when it broke out. If you think this is bull market and gold is over after just 1 year of making new highs, well, we'll have to see. I don't know. We'll have to see about that because that would be by far the shortest. These cycles last a lot longer than you think. And by no means am I some big gold bug. I'm not saying sell everything. We have about a 3% allocation to gold. I think that makes a lot of sense in a portfolio to have some exposure to gold, especially when you look at a year like 2022. Don't expect it to happen again. But when stocks and bonds are both down, gold was flat. I'm not saying it was great, but it did better than the other two assets. We still like gold here.
Got it. Got it. Let's talk about crypto here. I mean,
Yeah.
again, as it sort of continues to worm its way for better or for worse into more mainstream portfolios,
Mhm.
more advisors recommending it. What are your thoughts on that? I mean, is it something that, whether it's Bitcoin, whether it's other cryptos kind of further down the stack, is this a place people should be investing in? And what's your outlook for that space?
Yeah, I'm going to talk out of both sides of my mouth for the next minute or so. But I mean, it depends on the person, right? I work with financial advisors all the time. And I'll tell you, if you're younger, it makes sense. Have a couple percent, I think. I think it makes sense. But again, I wouldn't just say go all in Bitcoin. There's a lot of other ones. I can't really mention them just because of compliance reasons. But you can buy a basket of these. There's different ones you can buy. That just like with the .com burst and bust, and there were winners and there were losers. And crypto, I'm sorry, Bitcoin, I believe has had 6 separate 70% peak to trough corrections. Now, as the asset ages, maybe we won't have as many. I don't know. But just know
Yeah.
overnight these things can be down 20%. They can be up 20% as well. So again, from a younger person with time on their side, I mean, I think maybe it makes sense. We actually, for the first time in a while, we were one of the very first RAs back when those 11 ETFs were approved early last year. We were one of the very first RAs to approve that. Now, that doesn't mean we're investing in it, but we gave our advisors the option to make the decision for their clients. A lot of big places still will not let advisors and clients invest in these ETFs that are out there. We didn't see it that way, but the reality again, I think if you can afford a couple percent and you realize, well, it might go to zero tomorrow. That's how you have to look at it. But again, from a diversified portfolio point of view, there's probably a place for that in certain people's portfolios. Absolutely.
Okay, perfect. Just a reminder, as Sam mentioned earlier, if you're watching this, you've got some questions, something that comes on your mind as a result of this conversation, just type it in that chat box. Sam will be able to read it off to us, and Ryan will get those questions answered. Sam,
Yeah.
anything at the moment, or should I just keep going with what I've got?
No questions yet.
Okay,
We're
perfect.
halfway done. I mean, see how fast this goes? Look at that.
Yeah,
15 minutes.
right.
Unbelievable. I don't think I've said anything yet. Unreal. Yeah.
Well, let's pivot here a little bit and talk about a couple of the things that I think are on people's minds. And
Yeah.
we're in sort of one of those weeks where I think we're parsing Powell. We've got he's got his speech coming up on Friday. What's he gonna say? What CPI versus PPI. What are your thoughts on that part of the spectrum there in terms of what's gonna happen with policy as
Oh
we get
my
into the back half, rest
Oh
of the
my
back half of the
goodness. Well,
year?
yeah. Well, if I can do a brief promotion just for a second, I do have a podcast called Facts versus Feelings. Do with Sonu Varghese and JC was on it recently. So we dive in all this stuff on Facts versus Feelings. You want to check that out to be honored. But the reality is we do think that the Fed is literally the title of our podcast comes out tomorrow. I already recorded it. The Fed has an inflation problem. We think their inflation problem is a little bit worse than what a lot of people. When we looked at the data last week with the CPI and PPI, S&P was up 1.13% on Tuesday on CPI, and then up I think 13 basis points with PPI. Everybody freaked out on the PPI data. To us, we looked at the CPI data and said there are actually more worrisome signs there. Goods prices are starting to go higher. Services is kind of wishy-washy, but the good stuff's starting to go higher. So we're not saying inflation's soaring here, but our base case when 3 weeks ago everybody said, no rate cut. And then we had that terrible jobs number. Everybody said, 50 basis points multiple times. Now we're kind of in the middle. The truth is usually in the middle. The market is looking for about 2.5 cuts the rest of this year. We'll take the under. We're taking the under. Yeah, I think they're going to cut in September. Okay, I think there's a lot of pressure on Powell to cut in September. Jackson Hole, he's probably going to set the stage for that. And again, is there a really big difference between 4.5 and 4.25? I don't know. I mean, I don't really think so. So maybe 2 cuts the rest of this year. But we are a tad worried. And one, keep this real simple for everybody. There's something called sticky inflation, right? I believe it's the Atlanta Fed. Is it Atlanta or Cleveland? So sorry if I have it incorrect on which one it is. I think it's Atlanta. Atlanta Fed does a sticky CPI. All right. That's starting to move higher. Okay. Now, all I want to say is in 2021, sticky CPI was going higher. You know who didn't pay attention to it? The Fed. So we're seeing that happening again. So again, we're not saying we're going to have 9% inflation this time a year from now. But that is one thing that Sona, who really dives into this stuff, has said, I'm a little more worried about inflation. The market gives it credit. We think there's going to be less rate cuts. And for that reason, I know small caps just had a huge week last week. I get it.
Yeah.
Outperformed yesterday. No idea what they're doing today. We are underweight small caps relative to large. Believe me, we own a lot of small caps. I'm not saying we don't own it, but we think, again, maybe the market got ahead of itself once again, Lucy in the football, and we still think large is still the way to go. But the Fed's really, Mike, in a tough spot. I'm anxious to see what he says 10 o'clock Eastern time on Friday.
Yeah, for sure. Since you brought it up, growth, the jobs numbers, I mean, what do you see on the economic front there? I mean, is it kind of this soft landing scenario? Is there bad times ahead? Are you not really as concerned? Just kind of curious as to where on the spectrum you fall
Sure.
when it comes to that.
Yeah, we still think there's growth coming. We don't see a recession, but a little below trend, right? The second half of this year, we thought we could grow somewhere between 1% and 2% GDP. That's not great, but it's slowing down. We think the economy kind of troughed out in April and May, right? When everything went crazy with tariffs and everything went crazy with the market. I know the market bottomed in early April. Market tends to bottom before the economy, or maybe you could say May, June data. And clearly we got those huge revisions with the jobs data. That was shocking to a lot of us. Honestly, the PPI that came out last week came in at 0.92%, expected to be 0.21. I know that's a mouthful. Just know this. Mike, it was an 8 standard deviation event, okay? Beat by 8 standard deviation. That's supposed to happen once every 6.2 billion years. We see stuff like that that's what makes this job fun. We see stuff like that all the time, not 1.2 or 6.2 billion years. But anyway, back to jobs. I mean, yes, we've grown a lot less the last 3 months. We've seen these fits and starts before. Have we ever had a time where there was a lot more uncertainty than after the tariffs came out and after Liberation Day and after you had a 20% bear market and a 10.5% drop in 2 days and companies not knowing what to do? I mean, listen, it made sense, I guess, looking back, that growth really slowed down, or at least, sorry, the labor market slowed. But let's put a bow on this. What are initial claims saying? Initial claims continue to stay low. We're not seeing a spike there. That's one of our favorite real-time economic indicators. If things are really falling apart, we'd see initial claims spiking. And then one more thing I love to follow, the credit markets, right? Triple B spreads and corporate spreads, all that geeky stuff. We're not seeing any stress, like any stress in the credit markets. In April, when the market collapsed, high yield hung in there, and that was still down, yes, but high yield was like flat on the year, all right? And I just remember keep saying that, if the world was about to end like they're telling me on TV, high yield bonds, junk bonds, they'd be getting hit a lot harder. Last August, when we had the yen carry trade unwind for 3 days, everybody freaks out about the yen carry trade unwind. Market got drilled for 3 days. Once again, credit markets hung in there. High yield was I think the smart money, and I still think that's where we'll see, if there's a canary in the coal mine, we'll see some cracks there. So good news is we're not seeing that right now. So slower than what we've seen the last couple of years. Growth is how we see the second half of this year, but no recession.
Okay, fair enough. I guess the other thing that people are talking about is geopolitics for obvious reasons.
Yeah.
We've got these talks going on, and we just had these talks in DC. Now we got to figure out Putin, Zelensky, what's going to happen next. Any thoughts from a market perspective? Is that something that's just going to kind of continue to simmer in the background and probably not going to impact markets? Or you have any thoughts about, what might happen there, China, whatever?
Yeah, that's a tough one. I mean, I think simmer in the background's the way to put it. I mean, clearly, I hope, probably like everyone out there, that we can get some type of major resolution with Ukraine and Russia, that might get a short-term market pop. I've done this long enough to know, though, that wouldn't it be something if you get some type of a resolution, then the market has a sell the news mentality, even though as great as that will be, maybe that could be the time for it. I've looked into it a lot, and I know you have too, but, geopolitical events aren't fun. There's been a lot of negative ones throughout history. You can have some near-term volatility, but the honest truth is markets tend to look forward to that. I mean, one of the strongest stock markets in the entire world since October 2023 is Israel, right? Israel, obviously, a lot of spending going on. They had a budget surplus. Now they have a little bit of a budget deficit as a percent of their GDP. Historically, when you have a negative deficits as a percent of GDP because of defense spending or tax cut spending, you tend to get a better economy and you tend to get better earnings growth. And I know that sounds a little contrary to what people think. 2003, March of 2003 is when the stock market in the US bottomed after a vicious 3-year bear market where everything was horrible, right? After that time, I was day trading in 1999. I had to pay the piper then too. But the reality is that's when the war started with Iraq. And that's when a lot of spending came in. I think the market sniffed out that that's when all that spending was going to come in. I'm not crazy about deficits. I'm sure most people aren't crazy about deficits and spending. But the reality is, you know, you can have actually better earnings when you have bigger deficits. I mean, last comment on this, Great Depression, stock market did terrible, obviously, for decades. What
Yeah.
really got us out of that? It was World War II. I mean, we're not saying that was a good event by any means, but that's really what got our economy out of the malaise of the Great Depression, and then eventually broke out to the new highs in 1950 and had a 20-year bull market on the heels, honestly, of a lot of things that took place, specifically deficit spending and growing the economy that way around World War II. So there's some interesting things to think about. But bad events happen. They're terrible. If China does something with Taiwan, you could say all bets are off. I
Yeah.
have no clue there, but we're watching it closely. But all in all, still focus on the credit markets, focus on earnings growth, focus on inflation, and all those. Although we're a little more worried about inflation, they're all still more positive than not right now.
Got it. Well, let's bring it back to the tactical then. I mean, you've talked about some of the assets that you like, some, gold, for example, foreign stocks vis-a-vis US. What about
Yeah.
within the US and sectors? I mean,
Yeah.
besides tech, what else do you like? Is there anything that you think can kind of take that baton from tech as we roll into the next year?
There's some I think I can, but maybe they're not going to. Feels like tech never gives that. They get, remember DeepSeek? I mean, it's kind of like one of those, like, might be a Jeopardy question someday. I mean, in February, tech was crushed, right? I mean, all these Mag 7 were down, and Nvidia was down 40% or something. I mean, tech did terribly. Now, tech led for 2 years in a row, so it was due for some type of a pullback. But sure enough, tech's come back. Now, we like the cyclical areas still. Things like industrials, things like financials, obviously parts of technology. Those are areas that we've been overweight for a while. We still think there's a lot of opportunity there with deregulation coming and just again an economy. I mean, honestly, a lot of people think the economy is going to slow a lot. I mean, that's kind of what we're hearing. We're hearing a
Yeah.
lot of worry. So again, I'm not saying the economy is going to go rip roaring gangbusters here, but maybe it grows a little bit better than people think. Maybe we get a rate cut or two, and that can kind of grease the wheels as well. So those cyclical areas are the ones that we like. We've brought them to the dance, and we're sticking with them.
Okay. I don't know about compliance reasons. Are you able to name a couple individual stocks or ETFs that you like, or we just have to kind of keep it at the sector level?
Yeah, I'm not really allowed to. I don't know. Is anyone listening? I don't know. But honestly, I don't do that much with individual stocks. I really don't. We stick with just the big sector ETFs. I mean, like with I can say, I mean, this with like XLI, we've got a lot of XLI, right? And with the big sector ETFs are kind of what we tend to focus on from that point of view.
Fair enough. One thing I want to, it's going to name an individual stock, but it's not really a buy or sell. It's more
Yeah.
like the tactics of it. Talking about UNH, I'm kind of curious about your approach with a name like that that's been beaten to heck.
Yep.
The Warren Buffett approach to buying or trading versus sort of the falling knife catching. What are your thoughts on a situation like that? Just because it's been in the news.
Yeah, I personally don't like to try to catch a falling knife. I know it looks pretty good when you can pull it off. You get cut a little bit when you do it. I like to see some relative strength first. Healthcare, we've been underway healthcare for a very long time. There's been lots of reasons. Oh, maybe healthcare is going to do this, healthcare is going to do that. I've heard that for years now. And relative strength for healthcare has continued to go lower. So when I say relative strength, I mean, the sector ETF, XLP, relative to the S&P 500 ETF, right? And if that line's going lower, that's one that I'm not too crazy about. Doesn't mean I'm not going to have exposure to it somewhere, but I'm going to be underweight that particular area. Now with healthcare, obviously we know a big reason it's underperformed is because United Healthcare, right? I mean, that stock is obviously just done horribly. It was the largest, quote unquote, largest stock in the Dow because Dow was price based, as we all know. But it obviously has had a rough go. But now, stop going down. Which is the first thing you need to see. But we want to see a little bit more relative strength on a sector basis. And one other thing on sectors and analysis, you can use equal weight, right? You can use equal weight because we know, yeah, if you look at healthcare, well, so much of it's United Healthcare. Well, you can
Yeah.
look at healthcare on an equal weight basis. It might give you more of a clue of what's really happening kind of under the surface. When we look at something like utility, no, wrong one. We look at industrials. Historically, the R squared, so the coefficient, is the highest with the market, right? Utilities and the market tend to trade about the same. Well,
Yeah.
industrials have like doubled the S&P 500. Okay, so like they're doing really well relative to the. So I think that's a really good sign, kind of underneath the surface with industrials. I mean, Uber's an industrial. The industrials are like there's everything under there. Industrials are everything. But to see that leadership, I think is a good sign.
Okay. Sam, any questions that you've got there queued up?
Yeah, we do have a couple, and you
Okay,
might have
sure.
already touched on this,
Mhm.
but are there any sectors or asset classes you think investors are underestimating right now?
Mhm. Ooh, that's a good one. I still think gold. I mean, we kind of already talked about it. What is it, Mike? It's the Bank of America Global Fund Manager Survey. It
Yeah.
came out just last week, and what was the exact number?
I think it was
41%, Mike? Yeah.
41% had no exposure, something like that.
Yeah, 41% of big money investors that have a lot of money have no exposure to gold. I don't know. I'm somewhat skeptical of that number, but I guess maybe not, you know? So I think gold is one that is extremely underheld, underappreciated, underloved. It's a commodity. Well, it's obviously a commodity. It's an asset that is trending higher. I've done this a while. Sometimes those assets trending higher you want to be in because you never know when they're going to stop, right? So I think that is one really good example. Small caps are maybe I'm going to take the other side. So that's one area. Small caps the other side. They're underloved, underappreciated, maybe for the right reasons. They're cheap. I mean, I've done this for a while. Small caps are cheap. Small caps are cheap. We've heard that for a long time.
Yeah.
I think they're cheap for a reason. I mean, look at IPO. Now, I know there's been some big IPOs lately, although these IPOs that come out, I don't even know if they started as a small cap or they turn into a mid cap like overnight. So many companies are staying private longer. I mean, heck, I might work at one that maybe would have had an IPO this time 10 years ago, 15
Yeah.
years ago. We're pretty big. We're not doing that for various reasons. There's a lot of companies worth between $2 to $5 billion that are not going public. Now, I know some are because they're seeing that maybe some of the crypto ones are doing it now. They're all raised. I saw the Winklevoss twins. They've got an IPO coming,
Yep.
so
Yep.
it's like, oh, that's interesting. But the reality is, I think a lot of companies are simply not going, or when they go public, they're already like a large cap or a mid cap. So anyway, I think small caps are one that I hear a decent amount about, but I still think, maybe have a little exposure, but by no means have an overweight exposure is how we see it on the small cap side of things.
Got it. Sam, what else you got queued up there? We got probably time for one or two more questions.
Okay, we have one more. What risks do you think are being overlooked in the market right now?
Yeah, I'd
Oh man,
say,
he stole the question I was going to ask. So there we
ooh,
go.
there you go. We got teamwork. Hopefully, this is my joke. It's just a joke. Hopefully, I can use the F word. We're all adults, right? We use the F word. The Fed. That's my F word joke. I'll stop there. Yeah, I think it could be the Fed. We do think they should be cutting. All right, I want to be clear. I know I'm talking about that there's a potentially inflation problem. Well, we've got a labor market weakness too.
Yeah.
So if the Fed is stubborn, and by the Fed being stubborn, I mean Jerome Powell, because what are we hearing? Feels like every day everybody wants his job. They're going on TV saying how dovish they'll be to get President Trump. Hey, look at me, President Trump. I'll cut 150 basis points. I don't know if anyone's really said that, but you get the joke I'm using here. I think he's going to set the stage on Friday, but we've done this a while, Mike. I mean, you remember December 2018, right?
Yeah.
The market was pricing in a cut. Everybody thought the Fed was going to cut, and they didn't. Okay, and then what happened? If you go back in your history books, we got a 20% drop in like 4 days into Christmas Eve. Market bounced a little bit, and then like the first week of 2019, Powell's like, "Oh, never mind. Now I'm dovish," and the market took off from there. Another great example is 2022 right now. Okay, Jackson
Okay.
Hole Symposium 2022. It was widely assumed that Powell would come off a little bit more dovish just because there was why I don't even remember it now. I just know the headlines. But the reality is he didn't. He came off extremely hawkish. Market, which was recovering that summer after the vicious sell-off earlier in the spring, just cratered and crashed into October. And again, that was Powell, I think, being maybe potentially stubborn again. I'm not like a Fed basher or apologist or anything, but in late 21, I was talking about everybody getting money from the government and sticky inflation going higher. If that's all you knew, people just day trading, getting money from the government and sticky inflation going higher, you might have said, gee, maybe the Fed should hike a couple times because it just sounds like we're a little too crazy. They didn't. They were way behind the eight ball. Sonu and I on our podcast earlier this year were saying the Fed should be cutting because earlier this year we didn't have an inflation problem. The
Yeah.
Fed should have been cutting earlier this year. Then the inflation stuff happened. I'm sorry. Then the tariff stuff happened, and they kind of had to go on pause for a little bit. Now it's a dicier situation, but because the labor market is kind of weakening, the Fed has a dual mandate, right? Full employment and keep prices under control. I mean, that's where it's a tricky spot they're in. They should cut. If they don't, though, that's a worry of mine and probably a lot of other people that the market's probably not going to like that very much. Maybe that's why you should own some gold. It's the
Yeah.
way to
Fair
put it.
enough.
Yeah. Yeah.
Well, listen, everybody, if you're watching this, really appreciate your time. Hope you got a lot out of this session. Ryan, just in case you didn't see the schedule, is going to be doing a solo presentation a little bit later this morning. That's 11:15 a.m. Title of that one is Why This Bull Market is Younger Than You Think. So you're gonna have a chance to see a little bit more of what he's seeing in this market, get some slides, I think, as well. And
Oh yeah,
really
I just put it together this morning. I've got way too many slides for 30 minutes. I talk fast, I get excited, so we got a lot to talk about in about 45 minutes. Yeah.
perfect. Well, again, viewers, make sure you tune in for that. Ryan, thank you so much for joining me for this one. It was a lot of fun, and look forward to the next time.
No, this was an honor. Big fan of Money Show, and Mike, thank you for this invite, and I look forward to doing another one of these anytime you need me. This is very easy to do with the again nice, cool air conditioning, no hot fire. But appreciate it. And I'll see everybody in about 45 minutes. Thank you very much.
Perfect. Sounds good.
Thank you, and hope to see everybody in the next session. Thank you.